Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Hello, team, and friends and family and listeners and clients and prospective clients and other agents and people and peeps and peeps and peeps and enemies. I know that some of my enemies, the naysayers, so to speak, listen to the show and they try to come up with some sort of ammo to fight the truth as if there's a way to prove that 2 plus 2 isn't 4, but whatever. Knock yourself out, because when you guys try and I expose you and help everybody listening, it's awesome sauce. It's awesome. Today we're going to do episode 175. 75, that was 25 years ago. We're going to do episode 175 called Liquidity Sucks. What? I'm going to do 4 episodes. There's a series here. 4 episodes. One is Liquidity Sucks. Safety is stupid. Scroll down. Rate of return is not necessary, and taxes are awesome. So liquidity sucks, safety is stupid, rate of return is not necessary, and taxes are awesome. Why am I doing liquidity sucks now? Because we just saw a drop in the market of 20-30%. It's wiggling back up and then going down, wiggling back up. Who knows where it's going to go? But it brings up a really important piece to understand about liquidity. I'm going to give you what I've seen over the last 16 years at this point, and give you my thoughts on it, because that's all I can do on my show. There are some things that are 2 plus 2 is 4. There are some things that are my thoughts and my experience, and I'm going to give you a little bit of both on this show. You know, part of my job in the industry, I'm self-proclaimed as the financial services whistleblower, the benevolent king over Americans, protecting them from the bad guys, reappointing myself to every term. Yes, that's a little bit me, but people needed it, and it's working. So I'm going to stick with it. Part of my job in the industry is to help people see what's true or what's accurate, see reality, instead of what their advisor wants them to see or what the industry wants them to believe or feel. And in the area of liquidity, there's a reality that I don't believe most people see. And why is it that I don't believe that most people see this? Because when suggesting things like annuities, or things like cash value life insurance, or things like land banking, when suggesting alternatives to the stock market, almost every time people will say the same thing. Certainly more than half, more than 50% of the times over the years. I even still get questions with this phrase that I hate so much inside of it, where they say, isn't my money going to be tied up? Tied up. What a phrase. Nobody wants to be tied up. Well, let's not go there, but nobody wants to be tied up by a bad guy, and they certainly don't want their money to be tied up. Well, if you pick any negative term, like, I don't want my money to be murdered, I don't want my money to be molested, I don't want my money to be pillaged. Of course, if you pick a negative term, no, we don't want any of our money to be blank. You fill in the blank with a negative. The issue is, what they're referring to is surrender penalties, or lack of 100% liquidity. So let's just have this conversation. Let me make you more intelligent. Let me make you more educated. Let me give you a tool. Let me give you an insight. Let me give you an epiphany that will increase your rate of return and allow you to take a pretty significant step in making your financial plan so much better. Because you may have a limitation on it right now that's just unnecessary. So let's talk about liquidity. Do you really need it? Do you need 100% of all of the money that you have saved for retirement, or do you need 100% of your net worth accessible to you without penalties at all times? And if you answered yes, I'd like you to ask yourself the following question. Why? Or possibly phrase it this way. Based on what past things I've seen family members or friends go through, if my net worth is $750,000, I might need to get my hands on $750,000, all of it, for something, for blank. What is that blank? What is that emergency that you've seen so many families go through, where they were not only needed to, but were willing to take every single dollar in their life that took them 10, 20, 30, 40, 50 years to amass, what's the emergency that you've seen over and over and over again that has led so many family and friends to be willing to spend their entire net worth on that one emergency that makes you want and feel like you need 100% liquidity? And you may hear it just in the phrasing, just the way I'm asking the question, because it comes from having done over 1,000 financial plans, probably 1,500 at this point. There is none. You've never seen anybody go through that emergency. Now, someone could spend their entire net worth if they didn't do their long-term planning very well, and they get to the end of their life and have Alzheimer's, or they have some other medical issue that causes them not to be able to do two of the 6 activities of daily living. So they go into a nursing home or have in-home care, and it costs $8,000, $9,000, $10,000 a month. You can burn through an entire retirement nest egg in 2, 3, 4 years that way. And that does happen. We know about that. That's why we plan for long life, short life, rough life, sick life, and into the next life. Sick life is, how are we going to get someone else to pay all of your medical expenses if you have Alzheimer's, or you need to spend $2, $3, $4, $500,000 fading out while you die? How do we get someone else to pay for that and have it not come out of your family's estate, and do that all at no cost or low cost? That's what the whole sick life division of my planning model is. So that's fine. We know that's coming. But what emergency, what non-medical emergency have you ever seen where somebody has $1 million saved up in mutual funds for their retirement? They're 49 years old, and they go, I'm going to take the entire $1 million, spend it on this emergency, and start over. I'm going to start saving for retirement at 49. The answer is none. Nobody needs 100% liquidity. Now let's talk about retirees, because this will make it even clearer. Picture someone you know who's retired, or maybe it's you. You're retired, or you're planning to retire. So you've retired. I'll just keep using $1 million. Doesn't matter if you have 100,000, 100 million, or a million. This doesn't matter. Your nest egg is your nest egg. All your money is all your money. It's the same for all of us. You got $1 million, and you're living off of it. Doesn't matter how. Doesn't matter if you're using annuities or life insurance or stocks, bonds, and mutual funds. It doesn't matter how. In this example, you've got $1 million, and it's providing income for you. You got a little bit of Social Security, but most of your income, the lion's share of your income, is coming from your $1 million. And you have something come up in your life. Maybe an opportunity, maybe a non-medical emergency. Can you ever picture being willing to spend the entire $1 million that is the goose that lays the golden eggs? It is giving you your income to pay your bills for the rest of your life in an inflationary environment when things are going to get more and more expensive. Can you ever picture spending the entire $1 million on any emergency? And I've asked this hundreds of times, if not thousands of times, and the answer is always the same. No. And I say, why? And people thinking properly will say, because that will leave me destitute. And I say, well, do you have any family members who've had an emergency and they literally spent every single dollar in their life? A non-medical emergency, they spent every single dollar and left themselves destitute with no income? Have you seen it so many times that to you this is the normal risk that we need to protect against by having 100% liquidity? No. I mean, how much liquidity do people really need? What are the emergencies? I'm talking about reality, not emotions. Emotions are pretty dangerous to trust. Reality, certainly not a false reality given to you by the Edward Morgan Lynch guys, or the captive agents at some insurance company where you have to sell just one insurance company stuff. Nobody who's steering you into their products or their strategy without showing you all of your options is going to tell you the truth. What are the non-medical emergencies that cost a lot of money? In all of my research, you guys have probably heard me say it before, I think replacing the roof on your home and replacing your car. So for most families, based on whether you have a 7,000 square foot home or a 1,300 square foot home, or you have a Tesla or you have a conservative car, it's probably $50,000 to $100,000, $50,000 to $150,000. So at any given time, most people would only ever need to be able to access, to be candid, it's like $5,000, $10,000, $15,000 for the types of things that come up. Somebody needs braces, or somebody needs to, whatever, put a down payment on a car or something like that. But let's just call it $50,000 to $100,000. All right, that sounds good. Well, if you have your money in the stock market, it's quote 100% liquid. There are no penalties. All right, cool. If you have your money in the bank, it's, quote, liquid. There's no penalties. There's just no rate of return. Okay. So the two options to give you this incredibly unnecessary but yet comfortable for some reason 100% liquidity are to have your money not working for you in the bank, or to have your money underperforming all of the safer tools and at risk in the market where it's not tax efficient either. The market was averaging for 19 years. At the end of 2019, it was averaging 6.01 before your fees. And then we just took a big hit to the market. We'll see if it comes back or not. But seriously, the 20-year average is starting to look like it's going to be 4.5% to 5%, depending on what happens this year. That is absolutely not worth any investment that can go down 10, 20, 30% at any given time and isn't tax efficient. If you're only going to make 4 to 5%, you better do it in a tax-free way where you're keeping the entire thing, or do it in a way where you can never lose any money, but you consistently chug along and make 4 to 5%. But people feel the need to have 100% liquidity. But do you really have 100% liquidity in a strategy that can lose value? It's mathematically not even possible to have 100% liquidity if your account can go down. What do I mean by that? All right. You put $100,000 into stocks, bonds, and mutual funds. It goes down to 80. How liquid is the $20,000 you lost? I mean, people are concerned about surrender penalties of 8% or 10% or 12% that you actually get to choose to pay if your emergency is important enough to you, but the market doesn't even give you a choice. It just takes your money. One day it's 100, next day it's 80. How liquid is the $20,000 that you lost? Think on this, guys. You're going to have an epiphany. Think about this. How liquid is the money you lost? It's not liquid at all. You cannot even get it with a penalty. You can't call your broker and say, that $20,000 I lost, I'm willing to pay a 12% surrender penalty for it. Can you please send it to me? It doesn't even exist anymore. It's vanished. It's not there. You have to wait for the market to tell you you're allowed to have it back. At least with $100,000 in an annuity or $100,000 somewhere like that, you can call up and say, no, my emergency or my opportunity is so important to me. I gave you $100,000. Give me the $88,000 because it's worth it to me. And if I was in the market and it went down 12% and I needed the money, I wouldn't have it anyway. It's exactly the same as the market. If you need your money at an inopportune time, you're going to get less than you want or less than you put in. If you take money out of the market after a crash, it's frankly not there. If you take money out of an annuity or something with surrender penalties, you only get some of it back, but most of it, and you're in control. Do you hear the difference? Do you hear the difference? Now, what's the other problem with an account that goes up and down? How liquid is it really when your $100,000 goes down to 80 grand? Your $100,000 goes down to 80 grand. You have an emergency, $10,000 you want to take out. You call up your broker and say, I'd like to take $10,000 out of your account. Be realistic about your broker and yourself. What do you think your broker is going to say to you if your account just lost 20% and you're going to take out more than 10% of what's left? So you're going to take out another $10,000 after a crash. What do you think they're going to say? Now, you may or may not know. I can tell you from being in the industry, they're going to say, do not take money out now. Now is not the time. It just took a major hit. You should leave it there and allow it to what? To recover. One of the differences in the planning that I've done for the last 16 years and the retirement plan that never fails is we never have to recover. Why would you want to recover when time is the most important variable in building net worth? If you do any calculator and say, what if I started saving at 30 years old and retired at 66? What if I waited to 40 and started saving the same amount of money? The difference between the amount of money you will see at age 66 is shocking. It's called the cost of waiting. In compound interest, in growing your net worth, time is the absolute most important factor. Why would we ever use a strategy where you suffer losses and then have to wait time to get back to where you'd already achieved and then start rebuilding from there? And hello, 2000 to 2019, the losses come again. 8 years later. And hello, the losses come again 12 years later, or whatever it is, 9 years later. Wait a minute, I just recovered from the last loss. How come these losses keep... Well, that's your choice. You make more money. All the data shows you make more money not experiencing any of the losses. Just go to mycharliespictures.com and look up my 50% participation rate annuity picture. You'll see you'd have 38% more money only taking half of the market ups and not experiencing any of the losses. It's up to you, man. It's your choice if you like losing money and then spending a bunch of time, typically 2, 3, 4 years to get it back, only to arrive at a place you'd already accomplished and then hope to grow from there, all in a strategy that's been paying less than 6% for almost a 20-year period and isn't tax efficient. Loser! Makes no sense to me, but I know it's very popular, so we have to talk about it. But truly, how liquid is your money if you just took a 20% hit and your broker is encouraging you strongly or even threatening you? Now is not the time to take money out, and you're feeling that feeling as well. So the reality is, the liquid investments, because they require that you sustain losses or give up rate of return if you put the money in the bank, the liquid investments are not liquid emotionally. And, by the way, something called reverse dollar cost averaging, if you were to lose 20% and take out another, $10,000 from that account, so you lose 20 grand off of 100, you're down to 80, you take out another 10, you're down to 70. That reverse dollar cost averaging, it's going to take you a long time. You're really going to hurt your account trying to recover. So this is something that is just really important to have an epiphany, is that your money's not that liquid anyway in the quote liquid strategies. You don't need 100% liquidity because you would never choose to leave your family destitute. You can't look around you. If you can email me. It's fine. Charlie@jewettwealth.com, CHARLIE at JEWETT wealth.com. You can email me if you've got 10 or 11 examples in your lifetime of people that have needed to spend every single dollar they've ever saved on some sort of a non-medical emergency. That's fine. But the point is, you don't need 100% liquidity, and you don't have it in the stock market anyway. So what are some of the alternatives? What could you do? Well, let's exaggerate it. Let's build an exaggerated financial plan. And if we still have all the liquidity we need when it's exaggerated, wouldn't it make sense that we'd have the liquidity we need in a normal financial plan that's not exaggerated? So let me give you a scenario that's not even that realistic, but somebody has $400,000. They put $200,000 into an income annuity. So they have in-case income increase. They want an emergency fund, liquidity, and they want to have a paycheck. So piggy banks, paychecks, and potential. They want an emergency fund, they want a paycheck during retirement, and then they want some growth money to cover inflation and medical expenses and things like that. Okay, great. They've got $100,000, or they have $400,000. 200 is non-qualified. It's not inside of an IRA or a 401k. It's already after tax. Maybe it's just sitting in the bank. Maybe it's sitting in mutual funds or whatever. And they've got $200,000 in an IRA or a 401k. So they have $200,000 pre-tax. Well, if they put the $200,000 pre-tax into an annuity, what's their liquidity? What happens in an emergency from the $200,000 that they put into income where they're buying a paycheck? What happens? Well, if you have any understanding of annuity illustrations, or you haven't been lied to, you will understand that indexed annuities cannot go down. There is nothing that ever reduces the accumulation value or your account size in an indexed annuity, unless you choose to have them charge you fees for some sort of a rider. But with a normal growth annuity, and even the income annuities we're using today, they don't have any fees. So the worst case scenario in an annuity, the ones that I think are the best annuities out there after researching all of them, give you a 10% free withdrawal, and when the market goes down, you don't lose a penny. So over the first 10 years, let's say the market went down for 10 years, we've never seen a $200,000 annuity. You could take $20,000 out every year, or any year. In any year, you could take $20,000 out, and there are no penalties. 100% liquidity on that $20,000 with no cost. And remember, we're in a strategy that doesn't go down when the market goes down. So it's not like your $200,000 is going to go to 160 or whatever, like in the market. It's always going to be $200,000. There's a very good possibility you're going to grow it, so you can take out 10% of that higher number, but it can't be less than $20,000. Well, cool. That covers literally every emergency I've ever seen that's non-medical. And why do I say non-medical? over and over and over and over again. Because most annuities and most life insurance contracts have a clause that says if you go into a nursing home or have the wrong medical thing happen to you, they'll waive the penalties and give it back to you. Okay, wonderful. So we're dealing with non-medical emergencies. My car broke. My daughter needs braces. My roof caved in. Whatever. $20,000 is a lot of money. So you could just use your annuity's liquidity feature, the 10% free withdrawal. But in my analogy, remember, in my scenario, I have them putting $200,000 somewhere else as well. So we had $200,000 inside of an IRA, and they wanted some income. Okay, IRA money is for retirement planning. Retirement planning is about income. You can't take the money out and stick it into life insurance or other strategies because you have to pay taxes first. So generally speaking, IRA money is going to go towards creating a paycheck. It's going to create income. So it goes into annuities. Well, what about non-IRA money? What about the $200,000 that was sitting in the bank or in mutual funds or just sitting outside somewhere? Generally speaking, we're going to build a tax-free retirement plan off of that. So let's say they use some life insurance strategy. Now, I went into the life insurance software and put it in over 3 years and said, what if it makes zero for 10 years? What if it to be super conservative? They've been averaging like 7 or 8%. So what if it made zero for 10 years? Didn't make any money. Same thing. The market didn't go up for the next 10 years or went up very little, just enough to cover the cost of insurance. And the liquidity inside of a policy that you're putting $200,000 in over a 3-year period, and the first year is about $54,000, next year is $111,000, next year is $167,000. The thing here, the first year is $34,000, then $91,000, then $147,000. I was actually looking at my column where I added them together to the $20,000 from the annuity. But in this little plan, this little picture that I created, some money in an annuity where you can access 10% with no penalty, some money in a life insurance policy where I'm exaggerating it. I'm making a very simple financial plan where we probably wouldn't do it this way. There'd be more involved, some land banking, some real estate, whatever. You might want stocks, bonds, and mutual funds. If you're good at it, that's fine. All that. You might own a business. But with this little picture, in the first year, the person has $55,000 available with no penalty to access. The second year is $111,000, then it's $167,000. Even if the annuity and the life insurance policy both average 0% rate of return for 10 years, they never have less than $100,000 after the first year. And in the first year, they have $55,000. And actually, there's more liquidity because they can get the money that hasn't gone. So they basically never have less than $100,000 of $150,000. It actually, what's the lowest number? Yeah, they never have less than $130,000 to $150,000 of liquidity. I've never seen anybody that has an emergency of that size and they would want to spend their entire nest egg on that emergency and leave themselves destitute. It's just not something that we see out there. So I'm wanting to make sure you guys are protecting yourselves against real things that actually happen in the world, like people running out of income before they die, people dying too soon, long life, short life, people needing to cover their emergencies we're talking about right now, sick life, long-term care. What we don't see ever is somebody who needs 100% of their money for any sort of an emergency. So what does that mean for you? What's the conclusion? I can tell you the conclusion is if you focus on liquidity, unnecessary, excessive, never been needed by anyone liquidity, you will always make less rate of return and probably pay more fees, to be honest, but you'll always make less rate of return and have a lower retirement income and leave less money behind to loved ones than if you open your eyes and accept the fact that emergencies don't come in that fashion very often. If you can find 10 families in your lifetime, I'll change my opinion. They don't come in that fashion where you have to spend every single dime you've ever saved, and the reality of who you are and how families react to, quote, emergencies. They wouldn't spend 100% of their money and leave themselves destitute because what is the job of that money? It's the goose that lays the golden egg and gives you income in retirement. So sticking all of your money, not using annuities or life insurance, which have a higher rate of return than the stock market for the last 19 years and definitely give you 30-40% more income in retirement, not using them because, quote, your money is tied up or it's not 100% liquid, you will damage yourself, your retirement plan. You will significantly lower the quality of lifestyle that you can have in retirement or extend your working years by 5, 10, or 15 years until you're comfortable retiring. It's too high a price to pay. It would be one thing if we're trying to protect against something that happens all the time. 1 out of 2 people get divorced. Cool. Do 1 out of 2 people that you've met, is it 50% of the people in your life have had an emergency and they had to take 100% of all of their retirement savings to pay for that emergency and leave themselves destitute and start over? 1 out of 2 people who are retired have chosen to spend their entire nest egg on some emergency and just go back to work for 30 years? Is that what you're telling me? No. You're trying to protect against something that does not happen instead of rejoicing, celebrating how amazing the world really is, and giving yourself that 30, 40, 50% more retirement income, or possibly retiring 5, 10, 15 years earlier. Guys, guys and girls, hopefully this helped you understand liquidity sucks. Having too much liquidity is going to hurt you. Don't do it. Liquidity's fine. Having a little bit, $20,000, $30,000, $40,000, $50,000. If you want 100, if you want 150, that's fine. If you put $1 million into an annuity, you still have access to $100,000 every single year with no penalty. You're going to be fine. Liquidity is not an issue in the types of financial plans that we build. If you need help, get in touch. Charlie@jewetwealth.com, CHARLIE at JEWETTwealth.com, or you can talk to the person that referred you to this podcast. Get in touch. Let's be friends. Let's chat, and let's fix that retirement plan to get you to and through retirement, because I think you people are the best. Goodbye, sayonara, adios.
Renovating retirement with Charlie Jewett.
That's all, folks.